Okay, let's dive into this. Welcome to today's Explainer, where we are unpacking one of the absolute most fascinating and, frankly, bizarre financial realities of our time. We're going to be looking at the strange, highly layered, and honestly kind of wild backdoor revolution happening in private investing. And specifically, we're focusing on the single most coveted private company on Earth right now, SpaceX.
I want you to picture this: a dental hygienist in suburban Phoenix, a retired teacher in Tampa, a software engineer in Austin. On a random Tuesday, for literally about the price of a nice steak dinner, these folks log into their everyday brokerage accounts and buy what they believe is a piece of Elon Musk's private rocket company. Now, none of these people are Wall Street insiders. None of them have ever even met a SpaceX employee. And yet, in a very real way, they are sitting right there on the cap table.
So that begs the obvious question, right? How exactly do everyday people own shares in a fiercely private company that has literally never gone public? I mean, SpaceX has stubbornly resisted the traditional public markets for a quarter of a century. They haven't sold a single share on the New York Stock Exchange or NASDAQ. Zero. Yet, hundreds of thousands of retail investors already have major skin in the game.
Which brings us to Section 1, unpacking the SPV, the financial plumbing.
To actually understand how this backstage access works, we have to peel back the first layer of this giant financial matryoshka doll. It all comes down to something called the Special Purpose Vehicle, or SPV. Now, what's really interesting about this slide is how this incredibly clinical-sounding, boring term solves massive regulatory barriers. An SPV is literally just a shell company built to do one single thing. And in this case, that one thing is holding private SpaceX shares on behalf of a large group of people who pool their money together. The anatomy of this transaction is actually surprisingly straightforward. Step 1, a sponsor, think like a fintech platform or venture firm, creates a Delaware LLC. Step 2, a group of everyday investors pool their money into that LLC. And finally, step 3, the LLC takes that pooled money and buys SpaceX stock from an existing holder. But here is the absolutely crucial distinction. You, the everyday investor, do not own direct SpaceX stock. Nope. You own membership units in the LLC, and the LLC owns the stock.
You might be wondering, well, why do it this way? Two massive reasons. First off, SpaceX legally demands a clean cap table. They do not want the administrative nightmare of tracking thousands of random retail buyers. So an SPV perfectly solves this by showing up as just one single line item on SpaceX's official records. Second, it's straight-up regulatory arbitrage. Federal law restricts private placements to wealthy accredited investors, usually capping these funds at around 100 people. But if you start stacking SPVs on top of other SPVs like a giant puzzle, you can completely bypass those strict limits and eventually funnel those shares right into a registered fund that anyone can buy. Moving right along to Section 2, the $800 billion rocket, a meteoric valuation.
So we know how they're buying in, but we really need to talk about why. Let's shift our focus to the massive underlying catalyst that is driving this absolutely unparalleled retail demand. The trajectory here is, well, it's almost hard to comprehend. Back in 2015, SpaceX was valued at roughly $12 billion, and Starlink was basically just a sketch on a whiteboard. By 2021, the valuation hits $100 billion. Fast forward to December 2025, and it skyrockets to $800 billion, largely driven by Starlink crossing the 9 million subscriber mark. And as we look toward early 2026, advisors are openly discussing rumored valuations between $1.5 and $2 trillion, trillion with a T.
And the hype? It isn't just hot air. The real-world operational fuel behind these numbers is staggering. We are talking about engineering milestones that were science fiction a decade ago. 170 launches in 2025 alone. Falcon 9 boosters flying 40 times apiece. Starlink adding an estimated 20,000 new customers every single day. Add to that a $2.9 billion NASA Artemis lander contract, and you can see exactly why retail investors are literally desperate to get a piece of the pie.
Which takes us to Section 3, skipping the velvet rope, platforms and retail wrappers.
All right, so we know the mechanics and we know the motivation, but how are these SPVs actually packaged and then aggressively sold to the retail public? Look, the institutional path and the retail path are two completely different realities. On the left, you have elite venture funds like Sequoia or Founders Fund buying directly. Smooth, clean. But on the right, you have this messy, multi-layered retail ecosystem. You've got secondary marketplaces like Forge and retail wrappers like Destiny Tech 100 or the ARK Venture Fund.
These registered funds wrap SPVs inside structures that anybody with a standard brokerage account can buy, without needing to be an accredited multimillionaire insider. And this brilliantly illustrates the sheer frenzy of it all. 2,000%. That is the massive premium that a fund called Destiny Tech 100, ticker symbol DXYZ, traded at over its actual net asset value shortly after it listed in 2024. Think about that. People were so absolutely desperate for the SpaceX exposure anchored inside this fund that they bid the price up to gravity-defying levels. They were effectively paying $800 for a share that mutual fund insiders were holding for under $100. The architects of these systems, they really view this as a necessary crusade. As Andrew Juji, the co-CEO of Republic, put it, the fact that retail investors couldn't own pre-IPO SpaceX has always been crazy to us. And this ideological push to democratize finance, it sounds empowering on the surface. But democratizing access, that also inherently means democratizing risk. Let's get into Section 4, Hidden Fees and Real Risks. The toll of democratization. Because this brings us to the core complication of our explainer. As it turns out, skipping the velvet rope is definitely not free. Just notice the drastic differences here in the implied per-share cost of SpaceX exposure, all depending on which door you walk through. If you're a SpaceX employee in a direct tender offer, it's $421. If you buy through a Forge SPV, it climbs to about $450. Through Equity Zen, $470. And if you bought through the Destiny Tech 100 retail wrapper at its premium, you were paying an implied price of over $700 for the exact same economic exposure. So where is all that extra money actually going? It's being eaten alive by stacked fees. You're paying a 1 to 2% setup fee, then an annual management fee, then a 10 to 20% carried interest on your gains. And if you buy through a closed-end fund that holds an SPV that holds another SPV, well, those expense ratios severely compound at every single level, quietly eating away at any potential retail profits before you even see a dime. And look, fees are just the financial cost. There's also massive structural risk here. Take the Linkto bankruptcy from July 2025. This platform promised accredited investors small slices of pre-IPO companies. Sounded great. But when the company filed for Chapter 11, the new CEO cited serious defects in the corporate formation. Actually, roughly 13,000 everyday investors suddenly found themselves completely entangled in bankruptcy court, holding interest in $500 million worth of private stock. It's an incredibly powerful illustration of what happens to everyday investors when these complex underlying corporate structures just break down. And the headaches really don't stop there. Holding SPVs often means dealing with incredibly complex, late-arriving K-1 tax forms across multiple states. Your money is completely illiquid, locked up for years. The underlying valuation, it's selectively managed by insiders. Plus, from a regulatory standpoint, the SEC recently eased caps on what registered vehicles can hold in private funds. This is a highly debated shift. Advocacy groups warn it just pushes private market risks onto retail investors, right as institutional buyers are pulling back. Regardless of where you stand on it, it directly impacts the everyday buyer. Finally, Section 5, the climax. The approaching mega IPO. Which brings us to the final looming chapter of this entire story. All of these layered funds, the stacked fees, the democratized risks, they're all about to violently collide with reality. So the crucial point is this. For years, everyone thought Starlink would spin off into its own company. But recent reports suggest Starlink is actually going to stay inside SpaceX, and the whole consolidated entity has confidentially filed for an IPO to fund Starship and orbital AI data centers. Retaining Starlink sets the stage for that rumored $1.5 to $2 trillion valuation. We are quite literally looking at potentially the largest, most anticipated IPO in financial history. But here is the final trap for the retail investor. If you own SpaceX through an SPV, you do not get to just log in and sell on day one of that massive IPO. No way! SPVs typically face strict 180-day lockups. During those first 6 months of what analysts predict will be violently volatile public trading, you are structurally constrained. You might watch the stock absolutely soar to the moon or completely plummet while you are entirely locked out of hitting the sell button. The democratization of private markets is absolutely real, but man, it is messy. Tens of thousands of small investors navigated an incredibly complex backdoor just to get a piece of Elon Musk's empire. But as that multi-trillion-dollar IPO rapidly approaches, it leaves us with one massive question. Did these retail investors successfully buy an early piece of the future, or did they just pay a massive premium for a front-row seat to the ultimate fee trap? It is definitely something to think about the next time you see a flashy pre-IPO pitch online. Thanks for joining me on this explainer, and keep learning.